Joining us now with more, we've got Rick Rieder, BlackRock Global Fixed Income Chief Investment Officer. And Rick, great to have you here with us this morning. First and foremost, perhaps set the stage for us. What most notably are you going to be latching onto when you're listening in from comments that come out of Jackson Hole later on this week?
Yeah, thanks, Brad. The key is going to be how much that slowing down of the economy is built in at this point. You still have an economy. Their dual mandate is full employment and price stability. You've got, if you look at the 3-month and 6-month moving averages of payroll, you've had 435,000 jobs and 465,000 jobs. That is not a slow economy. That is a robust economy. But like you say, you see that in the retailer numbers. The economy is moderating. The goods part of the economy is clearly moderating. So the key will be how much the Fed feels like they need to. There's no ambiguity around it. Inflation is going to be the number one priority. That's not changing. How much they feel like they can come off the boil a bit. Listen, I still think they're going to get another 75 basis point hike in. Now, we've got data. We've got an employment report coming out. We've got a CPI report. We've got a core PCE. So we'll see what the data suggests. But if the data is robust / inflation trending lower, then, I think the Fed will feel like, they're still in a good position. Let's do another 75. Let's front load it. And then you can start to back off and then watch the economy from there.
Of course, Rick, hey, it's Julie here. We're not getting the data before Friday, right? Before we hear from Jay Powell again. And do you think that the market has been too optimistic or disconnected from the Fed's message in thinking that the Fed is going to slow down imminently later this year, even cut next year? Do you think the market's getting that wrong?
So listen, I thought the equity market was overzealous over the last month. It was mind blowing to me. I kept thinking, listen, is the Fed not tightening financial conditions? So you think about, by the way, where the Fed is now. Financial conditions have eased significantly, not just the equity markets, the credit markets have all eased. So the ability. So when the Fed looked at it and said, gosh, we've been tightening financial conditions, one of our tools to bring down the rate of inflation, and now it's eased significantly. So I think it makes their job, quite frankly, a bit easier in that, maybe we could do a bit more. Listen, I think the markets have been overzealous. I think there's one thing, though, you have to put in perspective. If you think that, inflation is going to moderate, 10-year inflation break-evens are around 2.6%. Real rates are about 50 basis points. That gets you in the low threes in the 10-year. I don't think rates are going to move very far from here. And so the equity market, can they take comfort longer term? Rates should start to stabilize. I think so. But boy, that gap that we saw in terms of the market's overzealousness, I think was extreme. And I wouldn't be surprised if we still pull back a bit from here.
Yeah, Rick, and that, to your point, the market's being overzealous. Where do you think, how much downside risk is there here? Because it has been hard to understand what is the health of corporate America. Look at Nordstrom earnings saying higher income folks can't go out there and shop. They're not shopping clearance racks. Walmart and Target under pressure. There's a lot of things that have happened in August that I think the market has overlooked.
You're right. And so, how much downside is there? Listen, I don't think equity valuations are grossly too high. Could we pull back another 5 to 8%? I think so. And by the way, I think it'd be healthy for the markets if you got that sort of multiple that you start to put some money to work or be more thoughtful about putting money to work. But I think you're right on the earnings. By the way, they're mixed. There's some pretty good. Some of the tech numbers are pretty good. Some of the industrial numbers are pretty good. Some of the global numbers are better than I would have thought in Europe, particularly. So it's mixed. And listen, one of the places where I think there is return is the credit markets. None of these companies, certainly big companies, they're seeing some slowdown in their business, but there's no default dynamic. So I actually think for the first time in the last month, we've been letting the line, not last month, last 2 or 3 months, we've been letting the line out on some of the yielding assets in credit. And quite frankly, if you can get 7, 8, even 9% in high yield versus do I want to take the equity risk, I'll just carry and create better income into my portfolio. I feel like that's a better trade than taking the beta risk of equities right now. Again, I wouldn't get out of equities, but gosh, I think we'll get a chance to buy them at cheaper prices.
So, Rick, if we're talking about credit, whenever we talk about credit on the show, I like to let people know how they do that, right? Because if they're individuals and not big institutions, it's not quite as intuitive or easy to do that. So if you're talking to retail investors, maybe they should be looking at this stuff instead of Bed Bath & Beyond. I don't know. But how would they go about doing that?
I mean, without directly marketing our funds, I mean, the mutual funds are very attractive. We run a fund called Strategic Income Opportunities. It's very stable. I mean, look at it over time, very stable, consistent return. And we outperform the index virtually, most years, virtually every year with a lower volatility to it. So I think a lot of the mutual funds, some of the ETFs where you get exposure to the high yield market, the credit markets, are attractive. Things like HYG or LQD. I'd start wading into to some of that, and like I said, we already have. And I think getting yield. We were doing more of this over the last couple of days. You think about now the 2-year Treasury, 335. So if you say, gosh, when inflation's going to moderate, the 5-year inflation projection based on the break evens is about 285. You say, gosh, I can buy 2-year Treasuries, risk-free rate. I can get 335. Maybe I'll buy some high-quality credit, and I can get closer to 5 in some areas, 4.5 to 5. Boy, in an environment that's uncertain, I'm going to get 4.5 to 5. I'm going to buy high-quality assets. Julie, we haven't seen that in a long time.
Yeah.
That's pretty attractive in an uncertain world.
Yeah, definitely. It's something that people have not been used to in a really long time, for sure.
No.
Rick Rieder, it's always great to get some time with you.
Thanks, Julie.
Come down and see us down the East
That'd be
Village.
great.
Rick Rieder, BlackRock Global Fixed Income Chief Investment Officer. Appreciate your time this morning.